you can approach economic management from two perspectives. One of which, to fight inflation, you can actually say, let's tighten monetary supply if the challenge is coming from money supply. But if the challenge is not coming from money supply, then you focus on productivity. That's the converse of addressing inflation, because if you improve productivity, that is, you improve economic supply of goods and services. And there's an improvement in supply of goods and services without a commensurate increase in demand, then prices will come down. So you can also fight inflation from focusing on improving productivity. For an emerging economy like ours, where there is no matured sector of the economy, the emphasis of the central bank would be, how do we stimulate productive activity so as to improve supply of goods and services and bring down prices? For matured economies where they can't easily improve productivity because they are the limit of their productive activities, then what they focus on less constrained liquidity so that the available liquidity will not be too much for the available goods and services in the economy. So we should look at our peculiar situation and adopt the most appropriate economic policies that will drive address the economic challenges.
You talked about SMEs, that's small businesses, isn't it? Now, the small businesses, where do they borrow from? Because I also had this argument yesterday with central bankers yesterday. I was at the MPC. After the MPC, of course, engagement here and there with some of the central bankers off camera, definitely. And, you know, one of them actually told me that small businesses, they don't borrow from microfinance banks, for example, which we also know that this rate hike would impact them. So carefully just explain that to me, because I tried to, you know, put forth my own arguments yesterday with the two central bankers I was having that argument with yesterday.
Okay, what I said earlier, which your question would now entail that I emphasize this further, is that the small and medium scale enterprises are the least that have access to funding. And this is a hierarchy of funding and access. The multinationals, those who can borrow on the strength of their balance sheet, who can issue commercial papers, will be the first to access credit. After them, you get the big corporates, the local big corporates, who have strong balance sheets, who have relatively strong cash flow. They will now be the next to access credit. And in terms of pricing or the cost of credit, it's also in that order of ranking. Those with stronger balance sheets that can borrow clean with access credit at the lower interest rates. Then after the multinationals, you have the local corporates. After the local corporate, you have the commercial enterprises, the trading outlets, businesses. They will now be the next to access credit. Then whatever is left of the credit availability is what goes to the small and medium scale enterprises. Not only that it goes to them, the conditions under which they will access it are conditions that hardly they are able to meet. And again, the lenders will also have to price in the higher risk associated with lending to the small and medium scale enterprises. So at the point in time when you have an economic environment where the lending rate, even to the blue chip companies, is in the region of 30-35%. You can imagine the rate at which the small and medium scale enterprises are borrowing from, because for those higher risk borrowers, or what they call subprime borrowers in other countries, they have to price in the risk of default in lending to them. So for an SME to go to a bank to borrow now, they would borrow in the region of 45%. You did mention the aspect of they also borrow from the microfinance banks. Look at the rate at which they borrow from microfinance. They borrow on a flat monthly rate. Sometimes you see rates of 5%, but now the rates are ranging to 10% per month. So if you're borrowing at 10% per month, you're effectively borrowing at 60% per annum. In fact, effectively, if you analyze the amount at 60% per annum. So that's the rate they are borrowing. So if you have to borrow at 60% per annum, tell me what kind of return, what kind of profit margin you are making that will allow you to pay back the loan, service the debt, interest, and still make something for yourself. And it simply means that if we continue with the current interest rate environment, we are putting the small and medium scale enterprises, particularly, into very severe economic situation.
What kind of dilemma do you think that the central bank, as the monetary policy authority, is facing right now, in as much as we want to also, give them a hammer or perhaps beat them up, as it were? Are they in a very difficult situation? Because I have the communique here, and let me just read a bit from it, and I quote what Yemi Cardoso was saying yesterday. The committee thus reiterated several challenges facing confronting the effective moderation of food inflation, to include rising costs of transportation of farm produce, infrastructure-related constraint along the line of distribution network, security challenges in some food-producing areas, and the exchange rate pass-through to domestic prices for imported items. The MPC urged that more be done to address the security of farming communities to guarantee improved food production in these areas. That's definitely out of the MPC's memo, as it were. So how much can Cardoso do? Really, that's one. Then number two is, are you seeing a fantastically confused economic team right now? Because they are giving us the impression, even the acting director told me just earlier on, they're giving us an impression that they are seemingly coordinated in terms of fiscal and monetary. Are you seeing that? Because for every MPC meeting, this line always comes out. We urge the fiscal. We urge the fiscal. And it's been like that since I've been covering MPC. You know, we've urged the fiscal, except for perhaps during Sanusi days that we didn't see that because inflation was a bit moderated. And perhaps Soludo.
Okay, let me start from the challenges that the Monetary Policy Committee is facing today in terms of decision options. One, we are dealing with high inflation rate, which has been their focus to fight. You are dealing with slow economic growth. We saw a GDP grow about 2%, 4% last year. Then you are dealing with exchange rate depreciation. Of course, we saw the Naira recover in the month of February, March, towards the end of March, and then reversed. And we're talking about exchange rate at 1,500. And then they're also dealing with factors which are completely outside their control. Okay, so the other issues that they have to deal with, the issue of insecurity, which is beyond them. If you look at, for instance, then supporting infrastructure, particularly transport infrastructure, if you look at the inflation figures in the month of April, and you consider that urban inflation came at a print of about 36%, while as rural inflation came about at 1.4%. So in effect, there is almost a 5%, 500 basis point difference between the urban inflation rate and rural inflation rate, which speaks on to the fact that you really have to contend with difficulties of evacuating food produce from the rural areas to the urban areas. That is not to say that we have enough food production in the rural areas. But then you are talking of even a constraint as strong as to give you a 500 basis point difference in urban and rural inflation. That is very material. That's one of the highest we've seen recently. Part of which is because of the cost of transportation, higher cost of energy, or fuel sources that have to be paid by transporters to evacuate those goods. That's beyond what the monetary authority can do. Addressing the issue of the exchange rate issue has become like a hydra-headed problem, because after the recovery, despite the level of resources that have been thrown at it to make sure the Naira stabilize, we seem to have lost the narratives. If you recall, the central bank has withdrawn with the DMO, they've withdrawn about 14.4 trillion Naira from the economy, all in efforts to stabilize the exchange rate. That 14.4 trillion Naira, if you take an interest rate of just 20% per annum, you are talking of over $1 trillion Naira that would be paid as interest in 1 year. So that's a burden we have incurred, and this has not addressed the issue of exchange rate. So that means there's a limit to what the monetary authority can do when it comes to managing exchange rates. So some of these factors are completely outside the control of the monetary authorities. And that's why they keep going back and say in their communique, say, look, we need a harmonization of monetary and policy, monetary and fiscal policies. We need more activity in the fiscal space. Interestingly, under the current government, we can't accuse them of lacking in action as it relates to fiscal policies. But the challenge is that whether those actions they've taken have led to the desired effect on the economy or had led to the intended positive impact on the economy.
So where does it leave the central bank now as the monetary authority? Because where does it leave them? Where does it leave them? That's one. Then the second question is that how do we now achieve overall macroeconomic balance?
Okay, I think the starting point is they need to do an assessment of the outcome or the results of their policy so far. In 4 months' time, they've increased monetary policy rate by 750 basis points, from 18.75% to 26.25%. That's 750 basis points in a period of 4 months. Have that led to the desired impact? I talked about the fact that they have drawn about 14.4 trillion naira for the economy at an interest rate of more than 20%. Have that had the desired impact in stabilizing the exchange rate? If you take measures with this level of resource commitment or impact, and you're not seeing the desired effect, you ask yourself, is he at a the lag effect? Should I wait for another 3-6 months to see the impact, positive impact? If you think it's no longer a result of lag effect, then you need to do a cost reversal. I need to reevaluate the approach you have adopted. I had mentioned earlier that the approach to fighting inflation could be from multiple perspectives. If we are looking at a mature economy that has minimal headroom for improvement in productive activities, then your option would be to tighten liquidity. If we are an economy that has huge opportunities for growth in productive activities, your focus should be on improving productivity so as to produce more goods and services and reduce the price levels because of increase in supply that is not matched by an increase in demand. So you have to look at reevaluate or reassess the outcome of their policy decisions and look at, are there other options available to us? Are there other tools? Are there other things we can do differently other than going through a one directional movement?
Mr. Chukwu, if you're the central bank governor as of today, what would you do?
Well, I don't envy, I think I've said it at different public fora. I don't envy the central bank governor because he's doing a tactless job, because he's managing very multiple divergent factors. If I were the CBN governor today, I don't think I will continue with the level of tightening we're witnessing today. Because like I said, it has not generated the desired impact. The unfortunate thing we're going to deal with, Nancy, is that in the next couple of months, we're going to see a slowdown in economic activities, much slower than we all anticipate. You said we went to the market the other day, and we almost mobbed at the market when they were asking, Madam Nancy, I hope they called.
I'm telling you, and I was struggling. I was saying, I'm not finance minister, neither am I governor of central bank. I was telling them, they say we know, but now you get our mouth. They tell these people waiting they happen. I started explaining in the market, in different places. You know?
I was telling somebody yesterday that I move around a lot, and I move around the country quite often. Every month, I think I travel more than 15 times. And in the course of interacting with people from all segments of this country, the economic difficulties are really biting hard. So we have to ask ourselves, how do we moderate that? Are there policy options available? We've actually tried a low interest rate environment. Would that, with other supporting fiscal policies, lead to an improvement in productive activities and bring down inflation? Or is it the only course of action that's available to us, that's the only option we have is to keep tightening? At what point will this tightening manifest in lower inflation rates? That means this tightening will lead to an improvement in food production. Food inflation came at a rate of 40.53%. If you do not have improvement in food production, food prices will not come down, food inflation will not come down. This tightening will lead to a material appreciation in the exchange rate, so that the pass-through effect of a stronger naira will lead to a moderation in import-induced inflation. So I have to ask myself those questions. What are the factors of driving inflation? Major factors driving inflation are food inflation, energy inflation. We've seen an increase in tariff without an increase in supply, which simply means that people are incurring additional higher costs for the same level of service. That's inflation on its own. So if I take this assessment, I will now determine, am I on the right course, or are there other options? But like I said, any direction he moves, there are some booby traps there. But we need to look at, like I always say, that economic management is a very delicate balancing act. So in balancing it, you have to look at what are the options that are most productive or that will give me more value, economic and social value. Because when you're managing the economy, you're not just looking at economic value, you're also looking at social value. People who are suffering and crying for hunger, out of hunger, are the issues you have to also consider.
Okay, how do people like you in the wealth management space, investment advisory, how are you all sensitive to these rates? How sensitive are you to these rates, and what options or strategies can one begin to undertake now to preserve wealth? Because rate hikes too will impact all the sectors around finance. I don't know if what you guys are doing in terms of perhaps repricing your risk, re-strategizing and all of that.
No, that's what you normally do in situations like this. You review your customer's portfolio and advise them on how to rebalance their portfolio. In doing that, you look at what are the dominant investments in their portfolios. And normally, when you look at an environment where you have high interest rate environment, the natural advice to ask people to pivot from equity, variable income assets to fixed income assets that are going to give them higher return. Today, you can comfortably get yield in the region of 20% on money market instruments. And you ask yourself, can I get the same yield on other variable income assets? So if you cannot, you advise your customers to rebalance their portfolios and move from variable income assets to fixed income assets. Then beyond that, you also look at what are the outlook on exchange rates. Are they foreign currency denominated assets that will give me yield that will not just, that will make me generate returns above the local currency returns, and that will assure me some level of stability in the value of my asset. So I'm happy the federal government is coming to the market to issue diaspora dollar bonds or dollar instruments that will give us as investment advisors additional options that we can advise our customers to invest in. So the key thing is that at any point in time, you have to continue to review your portfolio constitution and advise your customers how to rebalance their portfolios to mitigate the risk inherent in the economy as well as optimize their returns.